I don't have to do the hard work that Aarti did in the morning of saying good morning and waking up everybody, because I presume everybody's at tea, coffee, and we are all set to start. So as she introduced, current chairperson going to be moderating session from the first and the initial chairperson of the CFA society. And I think I've been asked to introduce Sunil, but I really feel he needs no introduction. I think we all present here know him very well. But some things have to be done, so let me do that. Me and Sunil go back more than 25 years, and we both had hair at the time, black hair. Those were the days. But I think he's not just been a critical part of the CFA India Society, but also he's been a pioneer, and I think, in my words, a trailblazer in terms of development of the investment industry in the country. So I think give him a good round of applause for that. He's had a distinguished career. We all know him from his earlier days at Reliance, Reliance Capital and Reliance Mutual Fund as CIO, Global Head of Equities, etc. In his current role, he's a founder and the promoter of Abacus, and we all are very familiar with that firm as well. I think in terms of India growing, Sunil has been a great example of a beneficiary of the growth in the country. The firm that he started in 2018 is already managing over 36,000 crores. And I think congratulations, Sunil, on that. And let me not be the person who's, in between Sunil and the presentation that all of us are waiting. So let's welcome Sunil on the stage.
Hi, good morning. Thank you, Rajesh. And thank you, CFA Society, for having me here. I think, I'll just start with the topic I have in mind. We have limited time, obviously. One disclaimer, I think this presentation would have been apt if it would have been done 3-4 years back when stocks were cheap and you could actually find a lot of multi-baggers. So at this point of time, I think there are not too many of those kind of opportunities available, but it is always good to learn and to know. To that extent, please treat this presentation, which has some examples also, as purely an exercise to learn a facet of investing. I think in India, India presents a lot of opportunity. Rajesh mentioned about how each one of us, including me and Abacus, have been beneficiary. We have all been beneficiaries of India growing. And Indian investors, they understand the power of compounding, and they understand that if you stay invested, you'll make decent returns. But somewhere at the back of the mind, everyone wants to invest in stocks which can give disproportionate returns, or what we call multi-baggers. Thoda sa ek rehta hi hai keeda wo. So I think what we have tried to do in this presentation, obviously, is looking at various facets of how even simple things, if we keep in mind, we can identify, companies which can so-called be multi-baggers. So one very clearly is that Indian market itself has been a multi-bagger. And I think the idea of presenting this is that if you stay invested, even in the markets also eventually turn out to be multi-bagger. So if you see the 10-year CAGR return for the BSE small cap, it's 27%. What it means is that the market itself has become 10x in the last 10 years. I think that's a multi-bagger in itself. And even the large cap has grown 16% CAGR over the last 10 years. And I think this is the opportunity which the Indian markets have presented over the last few years. There have been funds which have grown like crazy, So the fund dearest to my heart is the fund called Reliance Growth Fund. It's now called Nippon Life India Growth Fund. The fund has become 400 times. Imagine investing 1 crore rupees in 1994, and you're sitting on 400 crores without doing anything, without tracking the markets, without tracking stocks, without getting hassled, without increasing your heartbeat, blood pressure. Just simple, plain vanilla, mutual fund investments also have led to significant multi-bagger kind of returns, And see, the returns on a CAGR basis have been like 19, 20, 22%, which is great. No one gets satisfied in India when you say 15% return or 20% return, but actually if you just amplify them over a period of time, you have multi-bagger returns, even in mutual funds. I think the point I'm trying to just highlight is that multi-baggers happen with time on your side and with very simple, I would say, non-extraordinary risk-taking, investing. This is a little bit on our strategy. I think what we have tried to do, थोड़ा बहुत खुद का भी marketing का मौका छोड़ने का नहीं. So we have two funds. One is the all-cap strategy, and the other is what we call the emerging opportunity strategy, which is our mid and small-cap strategy. This is a track record of me managing them. So the gray bar is when I used to manage the Reliance Growth Fund. In between, the orange is when we did not have a strategy, and on the right is the period when Abacus was managing a similar strategy. So across the board, I think it would have grown 758 times. And the other strategy over the last 14 years would have grown 233 times. So again, the idea is that, yes, you all are interested in picking stocks, but even if you would have just done plain vanilla India equity investing or plain vanilla mutual fund investing or plain vanilla investing in alpha players like us, there would have been more than multi-bagger returns which would have been made. I think India is a market which has a lot of opportunities. We have 6,000 listed companies, almost 2,000 companies, 2,500 companies trading regularly. We are a country which is very different. We are like, to some extent like US. We have presence across sectors. So it's not like Brazil, which is predominantly commodities, or Russia, which is to be predominantly oil and gas, or China, which is predominantly dependent on government policies. I think we are an entrepreneur-driven economy. We are a very diversified economy. So we have presence across banking, IT, auto, chemicals, pharma, cement, you name it, we have it. And I think the other thing which is happening is a lot of entrepreneurship coming up. So India grows because of entrepreneurs, and that also presents an opportunity because a lot of new companies, new sectors keep on coming up, for listing and open up opportunities for us to invest. Again, the good thing is that till 4-5 years back, maybe only 100 companies were well covered. Now maybe 200, 250 companies are well covered. And there are hundreds and hundreds of companies where there is no formal coverage. And I think that also brings up opportunity for someone who's willing to get deep into it, apply what you have learned in your professional life, in your educational life, including CFA, to put it to work. And when there is no coverage, obviously, not too many people know about those companies. And that also is a good, I would say, start towards trying to create some extra alpha. As I said, new companies, new businesses, huge IPOs. Now, though it is every day you have one IPO, but if you see year-wise, we have on an average had good 50, 60 companies which have got listed. And I'm not talking about the SME where there are 300-400 companies getting listed on an annual basis, but these are like the good, decent-sized companies. On an average, we have like 60, 70 companies which come up for listing. And again, those are opportunities because those are not very well covered. Obviously, for stock pickers, it has been great last 4-5 years. You see the number of companies who have given you more than 100% absolute returns. I think it's been a fabulous, fabulous run. Some companies, we don't have any view on any of these companies, but I'm just giving you to arouse your interest of how the returns have been. 1 year change, see so many companies having crazy returns. 5-year change, 53 times, 35 times, 19 times, 19 times, 30 times, 104 times. I think last 3, 4, 5 years have been a mega period for disproportionate returns. And that's why I said, I hope this presentation was done 3-4 years back rather than now, because today don't try to do any of this because there are not too many opportunities which are going to give you 10, 20, 30, 40%, 40 times returns. Again, the same thing on a 3-year basis, 5 times, 10 times, 5, just like it's just a representative list. And these are large companies. These are not very, very small companies. These are really, really large companies which have given very disproportionate returns. A company like Mahindra has become 4x in the last 5 years. So really, it's a mega cap. Again, just a list of companies. So I think coming to the main crux of this presentation, according to us, what are the characteristics which we should look at to try and identifying so-called multi-baggers. Just to clarify, we are very value and fundamental focused investors. We don't invest in loss-making companies, and therefore all these examples are purely based on balance sheet and fundamentals, and what characteristics we have tried to see which would have contributed to these companies doing very, very well. The other thing is, this has a benefit of hindsight. After things have already done, it is very easy to find a reason of why they would have done very, very well. But as I said, this is more to arouse our thinking and maybe act as a learning rather than trying to give you some tips of what to buy tomorrow. But I hope this is useful. So it's a very short presentation. I think I'll finish it well within my time, and maybe we'll have more time for Q&A. So I think the first thing is change in management. Market price typically is a function which I'll keep on repeating multiple times, is a function of EPS into PE. It's a simple formula. Market price is equal to EPS into PE. I think PE is perception, and perceptions change for a variety of reasons. One important reason for perception change is also management change. The other thing which management change does is many a times the company has potential, the business has potential, but maybe the management is not as passionate, not as driven, or not as focused on what the company should be doing. And therefore, multiple times we have seen where managements change, there is a huge opportunity which comes out. So, whenever you are looking at companies, just try to see any company where there has been a significant management change. Management change can be the overall promoter changing. Management change can also be the CEO changing. We have multiple examples. I have one example here, but multiple examples. JB Chemicals, private equity came in, the company just got re-rated. There have been so many other examples. There's an IPO coming of Hexaware, which used to be a listed company, and then it was got bought over by private equity. Now they are relisting at some multiple valuations. But even in existing companies, wherever there has been a change of management for the better, sometimes change of management can be for worse also. So it is upon us to assess whether the change of management is for the better or for worse. But a very classic example is a company called Tube Investments. Good group, good company, but obviously, growing at Hindu growth rate. And here you have a significant transformation. So see the original thing, they were growing at like 10, 12% year after year. And there was a change in management, and see how the profits have tripled in a matter of like 3 years. I think the best way of doing it was if you would have assessed the change in management, and you would have interacted with the management or even heard the management in public forum, you could have found that there was a different energy, a different thought process, focus on growth, focus on getting into new areas, acquisitions. They've acquired CG Power, they have now got into semiconductors on the EV front. I think that whole drive which the new management has brought has changed a good company, but growing at the traditional, South India growth rate, transforming into a really, really big giant. And you see the change in the price. It's become 10x in a matter of 5 years. And we are not talking about some micro cap or some company where there is a windfall or something. This is plain vanilla growth year after year, year after year, year after year. Reliance joined this company, and since then, I think the transformation has been just mind-boggling. So, first lesson obviously is whenever you are looking at tracking, see if there is a management change. Uh, if the group has changed, the promoter has changed, the CEO has changed, I think all these are good flags to do more work. Just don't buy it just because there has been a change of management, but it is obviously worth doing much more work and getting into more details of what this change in management can entail. What is the thought process of the new management versus the existing management, and what can be the change as far as the company is concerned. Second is consistent profit growth. As I mentioned earlier, I'll repeat it multiple times. Market price is equal to EPS into PE. EPS is the earnings, and we have all been taught in CFA and even in your other educational, qualifications of how to make fact sheets, spreadsheets, and how to create models and so on and so forth. So, EPS projection is easier to that extent. It just has to be an assumption of growth and margin. P is in no one's hand. P is basically what is given by the market. But what we have realized is that if a company keeps on growing consistently, the P multiples always explode. If there is variability in earnings, the P multiples to that extent do not expand. And multi-baggers are created when both EPS as well as P expand. If in 5 years the profits double, with the same P, the price will double. But if the P from 10 becomes 20, then the stock price will quadruple when the profits double. And I think we have seen it multiple times. When there is consistency in profit growth, you have a massive P re-rating. So this is a company called Polycab. I think when it came out with an IPO, it was trading at a 60-70% discount to Havells valuation. Company kept on consistently growing. If you see 500, 700, 800, 900, 1300, 1800. And then at some point of time, the market just exploded in terms of giving it a multiple high P. So P went up from 13 times to 56 times. So stock price is up 10x, out of which 4x is contributed by P multiple re-rating, and 2.5 times is contributed by profit rating, profit growth. So if the re-rating would not have happened, if the P would not have grown, then the price would have mimicked the growth in net profit, which was 2.5 times. So when there is a consistent growth in profit, markets invariably will assign a higher P multiple. It's a matter of time, So I think just try and see where there is consistency of earnings. At some point of time, you will get rewarded significantly because your profit is also increasing, and there is a massive re-rating which will happen. So anyway, the price will mimic the profit growth, so that to that extent you are safe. But if the re-rating happens, it will just explode. And re-rating happens automatically. It's not that someone comes and says that now it should be 20p or 30p or 40p. The market on a whole will start to believe that this company with its consistent growth deserves a much higher multiple. See the performance versus Havells. It was like significantly outperformed. So Havells has moved up maybe 2.5 times. Polycab has become 10 times. Same business, same industry, but consistency of profit has ensured that you have a massive, massive re-rating, because Havells, the profit were growing a little slower than this. It was significantly at a premium to this company, and then when the markets realized that the profit growth is as consistent, I think the P multiple of this company also expanded. The third thing is now split in the business of a company. So more often than not, companies have multiple businesses. Some businesses are great, some businesses are very lousy. I think some companies realize that because of this one lousy business, the investors are not looking at it. And it's a difficult decision, but now companies are more than willing to do some restructuring whereby, either they hive off, sell off the businesses which are not doing well, or they split the company into different businesses. So as an investor, you might like one business, you might not like the other business. And therefore, if there is a common company with both the businesses, the investor might not be willing to invest. वो छोटा सा भी negative होता है ना, I think by nature, I've seen that, even if it's a small component, when we go to meet the company, we always try to talk more about the things which are not working rather than which are working. And I think it creates a sort of, a mind block that this business is not doing well, therefore I will not be an investor. And we have seen that when the businesses get split, you have a significant sort of re-rating which happens. So this is a company, lousy company, in the sense that they had two businesses, sanitary ware and glass. In fact, sanitary ware was supposed to be a great business. Glass was supposed to be a commodity business. And because of this glass business, no one was looking at this company. So if you see for 3, 4, 5 years, the companies did not perform in terms of profitability, did not perform in terms of the stock price, because you had one lousy business and one so-called good business. And I think the company realized it. They hived off the two businesses. You see the change, the transformation which one of the businesses did. Profit jumped, stock price, only that portion has gone up crazy. The market cap from 500 crores for this business has become 5,000 crores. It's become a little bit more focused. And I think very clearly the benefit of demerger can be seen. The other business has sort of remained sort of flattish, but combined from like a 1,500 crore market cap, the split businesses are now worth 10,000 crores. Because there are investors who want to look at that business, and there are investors who want to look at the other businesses also. And when you split it, I think the merits, the profitability of both the segments can be clearly visible. And there have been multiple such examples, Adani has had like 4 or 5 businesses which have been split and listed separately, and they've gone ahead and created, multiple, I would say, growth. You had Mastech, which got split into Mastech and Majesco, and then you had a huge re-rating, and so many other examples. So I think also look at those signals where, this kind of things can happen. The fourth is, when we assess or analyze profitability, balance sheet, sometimes there are extraordinaries which are there as a part of the P&L, and that leads to the reported profits being much lower than what the actual business profits are. And I think this one-offs, when they stop, your reported profits go up. I think the ratios will look very, very different. And obviously the multiples will also go up. Second such thing would be obviously if the loss-making businesses get sold off. So, this is a company called Tanla. If you see their quarterly numbers from March 19 to June 20, it's marked in the box, you had a good EBITDA, but if you see they had write-offs, which was one-off kind of depreciation. And as a result of which, for 4 quarters, they were reporting a loss, even with EBITDA rising. So if you see, the EBITDA kept on rising from year to year, but because they had a huge non-cash depreciation, if you would have gone deep into it, if you would have gone into the balance sheet, the quarterly, the reporting, you would have realized that this is not going to continue forever. And the moment it stopped, you see that the change in the profitability. So I think this was a very good example of how we were ignoring the improving fundamentals, because the reported profit was very, very disappointing. It was almost a loss. But as I again repeat, the EBITDA kept on rising. And I think these are clear signs. And if you see, obviously it has come off a little bit. From the bottom, the stock just jumped. See that change in profitability. Sorry. See the change in profitability. And it was all because the write-offs sort of stopped. Obviously, the company did very well on the top line front also. But it was a great, if you would have noticed it, you would have hit the jackpot. The fifth, net loss, net profit, but huge cash profit. Again, there are a lot of examples where company keeps on generating huge cash profits, which are strengthening the base of the business, the size of the business. They are reducing the debt because of this huge cash profit. And once the balance sheet gets sort of more and more amenable to a proper debt equity, I think profitability just zooms. Very good example, it's a large company called Tata Communication. Again, if you see, the company was making losses, but see the cash profit, 1,500, 2,000, 2,000. So for a company which had a market cap at that point of time of around 10,000 crores, generating 2,000 of cash profit without any profit after tax. So net profit, not there. Obviously, everyone thought that company is not doing well, but they were, repairing what they had done, reduced Capex, used the cash profit into significantly transforming their balance sheet. And when the company started to generate profits, I think you see how the stock has behaved. So, example of how cash flows also are very important other than only the P&L, because cash flows will show you whether the company has been making some decent operating profit. There is no formula to find such companies. The formula is only to read as many balance sheets and track as many companies as possible, because if you do it consistently, I think there is no way you will miss any of these. Very, very simple, operating leverage. I think you have companies which have a variable cost and then you have a fixed cost. Obviously, fixed cost remains fixed. So if the top line grows without increasing the fixed cost, you have a huge jump in your operating profits, in your EBITDA margin, and it clearly flows into the bottom line. Lot of companies are there, particularly on the engineering side. Engineering goes through its phases. So you see this is a large company called ABB. We had a very tough economic situation then. The sales or revenues were not increasing, but EBITDA, the employee cost remained the same. There was some reduction, but remained the same. And margins, therefore, were very, very less because employee costs were eating away a lot of their operating profits. And I think this is what happened. The moment the sales went up, if you see the sales went up, employee costs hardly moved up. As a percentage of sales, they went down from 9.8 to 7.4, and there was a clear reflection of that in the operating margins being going crazy. And see the impact on profitability. Profits went up 4 times. Obviously, when profits go up 4 times, the P multiple also goes up, and you had a 10x in a very, very large company. So I think the thing to analyze there was, if the revenues double, will the fixed cost go up in the same proportion? So the 2 calls you had to take was, one, there is obviously operating leverage, and second is whether the revenues will go up. I think if you were certain about that, then this was not a very, very difficult thing to identify. I'm just highlighting some large companies also, because traditionally, and even now, people think that multi-baggers can be only from very small companies. But this is very clearly reflecting that even sizable companies can give you decent returns. Next is completion of Capex cycle. I think there are businesses, when they expand, the cycle from starting of the Capex to the starting of commercial production is 3-4 years. And in that 3-4 years, companies normally struggle because your balance sheet size increases. Sometimes expenses also increases if you borrow. And the benefit of the benefit of that expansion comes once the commercial production starts. And that is normally 3-4 years hence. And if you are, again, tracking those companies, you can be reasonably sort of certain that when the production comes into play, and if you are positive on the product which the company is going to make, there is going to be a huge swing as far as the company's profitability is concerned. So this is again a company called Deepak Nitrite. If you see, the profits did not grow, but they were embarking on a huge Capex. You see the fixed assets. They went up dramatically. But the revenues started to reflect from 19. Between 16 to 18, there was no move. But when that Capex started to flow into the revenues, you see the impact on profitability. The EBITDA, the profitability, obviously they got some benefit because the cycle of chemicals also was very strong in that period of time. But even if it would have been a normalized product pricing, the profit would have still gone up quite substantially. So 3 years it took them to set up this plant. And this is what happened. I think the same thing happened in Deepak Fertilizer to some extent also now. But a lot of companies who embark on Capex for 2-3 years, they have sort of ratios which deteriorate because balance sheet size will go up, but the revenue size will not go up. And as soon as those projects come in for commercial production, you will see a huge surge in profitability and see how the stock prices behave post that. Change of perception. I think we have clear perception. ये चोर है. ये कंपनी में कभी पैसा नहीं बना है. इसका कुछ नहीं होना है. There are a lot of perceptions. We bought Raymond. I think the perception was very bad. It worked out well. But there are many companies like that where we have a preconceived notion of perception. Because of past, our experience with them, because of some news flow which might have happened, or for whatever reason. And I think when there is change in perception, I think that is a clear sign of making outsized returns. The only thing is, don't buy anything where there is bad perception. I think you have to just see whether the business is good, your valuations are in your favor. So a change of little bit of perception will cause a dramatic change in things. So this is a company called APL Apollo Tube. Now, pipe business, 3% margin, even I did not buy it because मेरा perception था ये 2%, 3% का business है. Anyone दिल्ली में हो आप तो कोई भी पाइप की फैक्ट्री लगा सकता है. चाहिए क्या, वेल्ड ही तो करना है आपको. But perceptions change because of variety of reasons. The focus on ROC, focus on ROE, promoters constantly engaging. Obviously the numbers showing in terms of consistent growth in profitability and so on and so forth. But when the perception change, you see how the stock re-rate, and now it is trading at P multiples of a FMCG company rather than a 4-5 P multiple which a steel company or a pipe company used to get. There are opportunities which come in once in a while. These are not structural opportunities. These are, I would say, topical or one-off kind of an opportunity. I think there are a lot of cyclicals. I love cyclicals to some extent because the size of opportunity is huge. Suppose if it's a paper company, 5 lakh tons capacity. 5 lakh tons is 50 crore kgs. If the price of paper moves up by 10 rupee a kg, it's a swing of 500 crores. There are many bulk chemicals where we had this caustic soda. People have capacity of 3 lakh tons, 5 lakh tons, 10 lakh tons, which is like 30, 50, 100 crore kgs. Even a 5 rupee, 10 rupee swing in pricing because the cost of production does not move up is a huge swing in their EBITDA and profitability. But the lesson here is to buy these companies when no one is looking at them and when they are really in the downturn. So identify companies where even in the worst scenario, they are able to sustain in terms of some profit, some EBITDA. And when the cycle turns, I think you will have 2 or 3 or 4 of them do really well. I think as a fund house, we just ensure that these cyclical kind of companies don't go beyond 5-7% of our corpus, maybe 8-9%, because they will tend to really frustrate you and for maybe 2-3 years. But when they do well, I think it's huge. So if you see Supreme Petro, They have a capacity of 2 lakh, 3 lakh tons. As I said, 3 lakh tons is 30 crore kgs. So 30 crore kgs, and if the price jumps by 20, 30 rupees, the whole thing gets translated into EBITDA. So despite being a cyclical company, you have ended up making huge returns because huge capacity. Even in the worst case, they were making some profits. And when the price moved up, I think the profit just jumped. And we have seen instances of some companies who have been able to recover, like Deepak Nitrite. Their timing was so right. The whole Capex got recovered in like 2 years. So this is again something which you can keep an eye on. And then there are others, which is a little bit of change of perception, cheap by way of valuation. There are no triggers. You just have to keep on identifying them, meeting them. And then there are new themes, which we don't play too much because we like to see numbers. But, if you are in a solar theme or an EV theme or a defense theme or a railway theme, you will end up, at least in the near term, making a lot of returns, though we are not big fans of it. We need to see numbers. I think themes are good. But ultimately, when we are investing in equity, we are becoming a partner in the business. And we are going to become partner in the business where what we pay today will be more than repaid back to us by way of future profitability. But these are some other instances where, because of the huge optimism on that theme, stocks have ended up doing very, very well. So I think this is a very, very simple presentation. I am 3 minutes, 40 seconds earlier, so we can have questions for 3 minutes, 40 seconds more than what is normal. I just want to give you a little bit of perspective. Markets are not cheap. I would have loved to do a presentation titled What Not to Do, which would have been more apt, but sorry, I was traveling, I couldn't work on it. And this presentation would have been more apt 3-4 years back, but we'll always have that cycle. And hopefully, we will still have opportunities where we will be able to use some of these and try and identify some stocks which can give you a little bit of disproportionate returns. Thanks a lot. More than happy to answer any questions.
Thanks, Sunil. I think this was a wonderful presentation. We have all, the question about timing, and you said this could have been 3-4 years back. We'll know the correctness of that statement only after 3-4 years. So you never know. There's so many opportunities in the market all the time.
True.
But I think linking what you presented to value investing, because I think most of us here agree that growth and value appear to be two sides of the same coin, or as the earlier speaker pointed out, growth is baked into the value equation. So how do you think of these, not the themes, but identifying multi-baggers? You will have some screeners, you will have some checklists. How do you tie in all of this current market things when you're building a portfolio to this whole bigger equation of value?
So, frankly, value and growth are good topics to talk about. But ultimately, they have to converge. So if you buy something at 5p with zero growth, it is going to remain at 5p. So when you invest in equity, as I said earlier, you become partners in the business. And you would like to become a partner in the business, as I said earlier also, where what you pay today should be more than repaid back to you by way of future profitability. Right. And you want businesses which are going to add to that value constantly, which is where the growth comes in. So I think what we try to do is, we are not averse to buying a stock which is 30, 40p if it is growing at 20%, 25%. But just because something is called growth, you buy it at 80p even if the growth is 5% is something which we don't understand. So I'll just turn the table. Which are growth sectors? What is your definition of growth sectors? Which are growth sectors? FMCG? Is it a growth sector? No, it used to be a growth sector, boss. तभी 60-70p मिलता ना. आज आप लोग सब change कर दिया आपका. It is growing at 4%, 5%. Hindustan Lever declared a 1% growth. Last 10-year growth rate in volume terms is 5%. So I think we have built-in notion that this sector is growth and this sector is value and this sector is commodity. I think we have to come out of it. If you are calling something growth, then show me the growth. At least it should be higher than the nominal GDP growth rate. So if the GDP is growing at 6-7%, nominal GDP is 10%, a growth sector should grow at least at 14, 15%. So a lot of times, there is a huge disconnect between actually what is growth and what we refer to as growth. So we have very clear notions. Ideally, we never buy loss-making companies. We like to buy companies where there's a minimum ROC of at least 14, 15%. Because our view is that if we are investing in a company, the management should have the discipline of investing our money where they are at least making something more than the weighted average cost of capital. Weighted average cost of capital in India tends to be anywhere between 9% to 11%, depending on the analyst justifying what is the price. And I'll come to the analyst recommendations also. But that is what our view is, where profits can double at least in 5 years. Ideally in 4 years, but at least in 5 years, which is again 14, 15% profit growth. And visible P should be in the mid-teens. I think that is what we like. It is sometimes easy, sometimes it is difficult. So in 2020, we were looking at stocks which can double in 2 years. 2021, we were looking at stocks which can double in 3 years. Last year, we were looking at stocks which can double in 4 years. Now we are very happy looking at stocks which can double in 5 years. So I think your way of looking in your way of filtration also should take into account the reality of the markets. If markets are at 20 PE, you can't look at companies at the portfolio level doubling in like 2 years, 3 years time. So I think it's a combination of a lot of things. I don't have a straight answer, but I think I would have given you a gist of what will.
I think you covered a few questions out there because, from the questions that I have here, it was very clear that people are trying to understand what is the framework that you use. What are some of those thumb rules? And you did mention some of those. What are growth sectors? I think those, we had questions around that. So let me jump to some few more. Yeah, can you share some examples, or even a single good example of a multi-bagger that you, your team, etc., identified, but it didn't really play out that way over the last 3-5 years? And what are your learnings from there that you can share with us?
No, I think every investor will have stocks which don't play out. I think, our view is that as a portfolio manager, we should have a very clear sort of a framework which ensures that our mistakes are minimized. So we also have a framework we call the MEETS framework, which I have more or less covered, where M is management, but what is the quality of a good management? Or how do you know that this is a good management? See, in hindsight, you can say that this was a good management and this was not a good management. But if you ask me today what is a good management and not a good management, how do you determine? Someone, a Wharton educated is good management?
Yes. Bias.
Maybe not. So our criteria is very clear: discipline of capital. E is the earnings, which I said. The second is events, trends, and perception and disruptions. See, we are in a very disruptive world. We have to be aware of what can cause a business model of a company or a sector to just go belly up. So newspapers, we read newspapers. But advertisements have shifted to the digital mode because the youngsters are not reading newspapers. My kids tell me that you are outdated. You are reading yesterday's news because newspaper has yesterday's news. It got printed last night. We are reading today's news. Or even passenger vehicles. We had a big listing. If you go and see the world, companies are trading at 4-5 PE multiples on the passenger vehicle side. The only company which has created wealth is Tesla. Mercedes, BMW, Stellantis, Volkswagen, Volvo, they're all trading at 5-6 P. Stellantis is trading at 3-4 P. Even the parent of the company which got listed trades at 4 P. $10 billion profit and $40 billion market cap. Here we were willing to give them 25,000 crores at 2 lakh crore market cap. Maybe I'm wrong, I don't know. So I think that is again very important. And then timing is the best company is not necessarily the best stock if it is priced beyond perfection. So in the peak when we launched Abacus in 2018, that time quality ka bahut hawa chal raha tha. Only qualities were doing well, even funds who had quality, irrespective of the P, were doing well because it was buy at any price. We used to call it BAP, buy at any price. And we came out with an article called Bubble in Quality. And it was very simple, that the entire market cap of all commodities, all building materials, cement, mining put together was less than Hindustan Lever and Nestle combined. And the profit pool was 15x of that. So I think somewhere down the line, the best company might not be the best stock if it is priced beyond perfection. And we give the example of a paint company also. And then obviously there are some structural bits which Ravi mentioned, they will have to give it a premium. You can't buy a fast-growing company at 15p. So I think this is the structure. In terms of making mistakes, yes, we have also had our share of mistakes. Sometimes mistakes are because you did not assess it properly. More often the mistakes are because something else happened. Now, regulators are very, all over the place. If you have a pharma company and suddenly there is some US FDA, letter also, the stock tanks 20, 30%. What can you do about it? Or NBFC, suddenly we have an NBFC and suddenly the regulator came and said, no new lending. And stock fell by 30, 40%. So mistakes are there. The idea is to have those mistakes not necessarily because you have erred in your assessment, maybe because of external environment or because of the growth changing, but you will always have mistakes, and I don't think you should be fearful that you might make a mistake. The only thing which you should be worried about that your rights are more than your wrongs, and by a big margin. So your rights should go up 100, 200%, your wrongs should at best go down 20, 30%. You can't have a scenario where your wrongs become zero.
Ravi, just adding to what you shared, those three things, if you make mistakes. But then let me push you a little bit. Any example you can share with us?
So I'm just thinking where we have lost money. So I think in 2018-19, we had a paper company, a West Coast paper. I would not say it was a mistake because it qualified all our criteria. It was growing at 15%, ROEs was 18%, P was 5 times, but COVID happened and we could see that people were not even touching their newspapers. Children were not going to school, we were not going to office, printouts were not there. And we realized that we sold it off 20% lower, so I think it was an external thing. I think something which was our mistake was a company called Sadbhav Engineering early on when we started Abacus. I think the company was in EPC, they had huge debt. And at that point of time, to address that debt, they sold off their road assets to a large sovereign fund. And our view was that once that was behind us, the EPC business will do very, very well. But unfortunately, between the time of selling and the time of actual receipt took 2 years. And in that period, the debt even went up quite significantly. So we ended up selling that stock maybe 30, 40, 50% lower. So I think those mistakes keep on happening.
Good. It's nice of you to take some names because we are all here to learn from your experience, and I think taking specific names.
But I am a little bit wary of talking stock specific, I'll be very, very honest, because one, we are regulated, and second is sometimes it gets misinterpreted.
Yeah, I appreciate that. And I think on this topic of multi-baggers, let's come back to your presentation. We all, as you started the presentation, we all want multi-baggers. And even though the index has done well, ETFs do well, etc., we are still all looking for, I think it's in the Indian DNA, look for that stock which will go up 50, 100 times. Suppose I go and I buy a company, large cap, mid cap, small cap, and it starts performing as per expectations. This whole element of behavioral finance comes in, where the company's gone up, let's say, 5 times. Should I sell? Should I book profit? How do I know that from there it's going to do another 5 times? So what we want to understand from you is how do you manage your behavioral response to a multi-bagger as it starts performing on your expected lines?
So the reason I started this presentation with showing the index returns and the mutual fund returns and the fund returns was exactly to showcase that encashed multi-baggers happen only when you forget the investment. So as you rightly said, Rajesh, suppose if you go tomorrow and buy ABC Limited and the stock goes up 2, 3 times, 90% of the investors will be out of it. But at the same time, if you are in a mutual fund, you will not even look at it. And that's why I would say there would be more investors who would have benefited with mutual funds being multi-baggers than stocks. Because you have very, very few individuals, maybe a Rakesh Jhunjhunwala sat around with Trent for such a long time, or stalwarts like Nimish Bhai and so many others who would have sat through their investment for 20, 30 years. Because you need to give time. It's not that a stock goes up 5 times, it will not come off. It might come off 20, 30%. It is always possible. But you can't always keep on timing कि मैं इधर बेचूंगा, मैं इधर लूंगा, फिर मैं इधर बेचूंगा, फिर इधर लूंगा. वो होता ही नहीं है. It's not possible. So I think for an investor who is investing in a company, the thought process has to be very clear. What are the parameters which I would use to exit a stock?
Right.
And just because a stock becomes 10, 20% more expensive than your fair value, should you exit? I don't think so. I think as long as the stock keeps on performing, there is no reason to get worried about the near-term dips. Now, in the last 1 week, so many stocks would have fallen 15, 20%. Now, at hindsight, you can say, "Arey, mujhe hai na 15 October ko bech dena chahiye tha, and on 27th of October, I will buy it back." But it doesn't happen. It's all in a hindsight. So I think I would say that you will be fortunate if you are an investor in a format where you don't look at it on a day-to-day basis and your behavioral instincts don't overpower you. But if you are doing direct equity, then you be clear that these are the parameters which I would use to sell a stock, and then don't deviate from those parameters.
So essential takeaway for us is don't buy ABC Limited, buy Abacus Fund.
No, I'm not saying that. I'm absolutely not saying that. I'm just touching upon your behavioral thing.
So let's extend that argument a little bit more. So we're not buying ABC Limited, we're buying Abacus. But then, globally, if you look at numbers, nearly half the money that's coming into markets is going into ETF Limited. Everybody's saying index. Index is multi-bagger. Why do I apply my mind to which stocks to buy? Share your perspectives on this whole movement globally, and I think we are seeing that in India as well, towards indexes and indices.
No, to the credit of my peers who are great portfolio managers, they've been able to beat the index by a wide margin. So as long as you're confident that they're going to continue to do that, why should you sacrifice your return? Just because the world is moving to ETFs, you should move to ETFs and sacrifice your returns. आपका बाजू वाला ज़्यादा पैसा कमा लेगा वो. So I think the moment you start to get that feeling that beating the benchmark is getting tougher and tougher, I think ETFs are a great way to invest. But net of fees, if your returns are still higher than ETFs, why not? Why should you not look at an active fund manager who has done such a fabulous job? I don't think index has gone up 400 times the way Reliance Growth Fund has gone up 400 times. Index in the same period has gone up 150 times. Yeah. So it's a 250 times difference. So technically 1 crore invested in an index would have become 150 crores. That has become 400 crores. So अगर आपके लिए 250 crore प्यारा नहीं है, तो आप करिए. So I think in India it will come, but still there is time.
So not ABC, not ETF. Let me not promote.
No, and I am frankly, we don't have a mutual fund, but I'm a big fan of mutual fund because it's the simplest way of investing. Yeah. The simplest way of investing. Obviously, PMS or AIF, most welcome, but I'm just giving you a perspective that, because, you have so much flexibility. You just keep on investing and you don't have to bother, you can withdraw whenever you want.
So this whole quest for multi-baggers that we are discussing, I think a big change in the market over the last, let's say, 6 years has been the number of new demat accounts. Essentially, these are people who are mostly coming into the market for the first time. Either these are demat accounts which are going directly into the market, buying stocks, or these are demat accounts that are PMS, AIF kind of accounts. Now, we are in a space where we've never been before. So from roughly, I think, 2.5, 3 crores to now a little over 15 crores, this whole addition of 12, 13 crore new investors in the market, what do you think is going to be the reaction when markets really continue to correct as they corrected last week of this new money that's come into the market? And how does that tie in with their quest for finding really outperforming stocks or funds or multi-baggers, let's say?
So one is these accounts have not opened in PMS and AIF. We have very handful of accounts in PMS and AIF. I think most of them have opened up either to invest in mutual funds, which is a great way, or to invest in IPOs. I think the lure of investing in IPOs is very, very high. It's a good thing because ultimately for any investor to manage his or her finances, you need to have assets which will provide safety as far as capital is concerned, but also investments which would give you growth to beat the benchmark. Again, if you have a scenario, someone who's not invested last 10, 15 years in Indian equity markets and someone who's invested, for the same income level, for the same saving, the net wealth will be significantly different. Significantly different. और बस क्या है ना, it's not about money. It is also about relative money. एक आपने वो 3 Idiots पिक्चर देखी होगी, वो रिजल्ट आता है तो आमिर खान's name is not there. So his 2 friends get very sad. And then they see his name to be on the top. They get more sad. So दोस्त फेल होता है तो दुख होता है, फर्स्ट आता तो ज़्यादा दुख होता है. So it is not about only your absolute wealth, it is about your relative wealth also. And I think those who have been investing last 10, 15, 20 years methodically are relatively far wealthier. And I am very sure that investors who are investing today also will make decent returns. Yeah. But your thought process about return expectations have to be very clear. You can't make 30, 40% year after year. Otherwise, out of 140 crore people, we will have 10% of them richer than Warren Buffett over a period of time. Because compounding effect, 40% is doubling every 2 years. It's not going to happen. So I think some of these investors maybe have been sold dreams based on past performance. I think that is where there can be a little bit of disappointment. But if you are happy with a mid-teen kind of returns, I think India, with its 7% real growth, 10, 11% nominal growth, profit growth of maybe 12, 13% with 2, 3% of alpha being created, can still provide a lot of opportunity. In terms of near term, yes, I would say that almost I read the statistics, 75, 80% of investors have come after 2021 and they have never seen a down market. So thoda reality check to ho sakta hai kabhi bhi. I am very sure. I am not saying that markets are going to collapse, but that reality check can happen. I think that is where the behavior of those investors will come into play. But, interacting with a lot of people, on a daily basis, including this huge group here, I think the maturity of investors in India has definitely improved. I don't think a scenario where SIPs are going to shut down just because 1 month markets are down by 5, 6%, or new investors will not come in. We are a country of 140 crore people. Right now, only 40 crore can afford some kind of savings. But 10 years hence, we will have 100 crore people who will be able to afford some sort of savings, which is an addition of 60 crore new potential savers. And even if out of them 15, 20, 25% come to equity markets, this number of 10 crore, 12 crore will easily double over the next 10, 12 years. So I think we are in a good situation as far as flows are concerned, maturity of investors are concerned. Only thing is have return expectations which are reasonable and moderate, and let your investments take some time to grow.
Great. So at the end of your presentation, you again repeated that this presentation is 3-4 years dated, but you would rather have made a presentation on what not to do. So unfortunately, we don't have that presentation, but fortunately, we have him here. So, so a few pointers of what not to do.
No, I think it is very, very clear. As I said, one is what we just mentioned. I think don't have outsized expectations. Markets are going to ultimately mimic the underlying growth of the economy and then the underlying growth in terms of profit of your investee companies. So don't have return expectations which are outsized. We are not cheap in terms of PE multiple, so there is no scope for PE re-rating. At best, you will make returns which mimic the profit growth of the underlying. Second, obviously, is, just very jokingly, day before yesterday, someone sent me a message that this company is there. It's a private company. We recently launched a private equity fund. तो आजकल मेरे को listed से ज़्यादा private equity के अभी offer आने शुरू हो गए. वो this company is there. तो मैं बोला great. मैं बोला what is the ask? तो 9,000 crores में IPO आएगा, but you have a good name, we will give you at 7,000. मैं बोला क्या मेहरबानी है बस. So I started seeing the fundamentals. They made 35 crores of net profit in FY24. मैं बोला ये 35 crores तो मैं value investor अपने आप को बोलता हूँ. ये तो growth का भी बाप है. तो बोला no, in 27 they will do 600 crores of profit. मैं बोला wow. तो मैंने उसको बोला you know what? In 27 I am going to be the Prime Minister of India. So I think it is so easy to extrapolate projections on a spreadsheet. बहुत easy है. Last 5 साल में 5 करोड़ से 35 करोड़ पहुंचा और अगले 3 साल में 35 का सीधा 700 हो जाएगा. It's so easy. I'll invest 1,000 crores, वो भी हमसे लेगा. और फिर उसको फैक्ट्री लगाएगा, फैक्ट्री विल बी ऑपरेशनल फ्रॉम day one and incremental ROE will be 40-50%. Incremental. See, if you invest 10 crores, you can make 40%, 50% ROE. If you invest 1,000, 2,000 crore, you can't make 50% incremental ROE. नहीं तो पूरी दुनिया वो धंधे में आ जाएगी. So I think just stay away from lofty projection. Third is FOMO. बहुत clear है. Again, I was on this Diwali के show में सब चल रहा है. Normally, I have started avoiding TV because बोलूँ क्या? But Diwali में you can't say no. So I, Madhu Bhaiya, Ramdev Bhaiya, and Nilesh and all were there. And I mentioned a point was, when the investment banker is coming with a proposal, they are not giving you fundamentals.
Yeah.
वो बोलता है, आशीष कचोलिया ने एग्री कर लिया, रवि धर्मशी इज कमिंग इन, मधु इज कमिंग इन, आकाश इज कमिंग इन, आपको डालना है तो डालो, नहीं तो बुक फुल हो गया है. दैट इज द पिच. फिर आप लोग क्या करते हो, पेपर में नाम आता है, सुनील सिंघानिया ने डाला, तो आंख बंद करके आप भी डाल देते हो. होता है ना वैसे. सो आई थिंक यू हैव टू नाउ रेजिस्ट द लियोर of not getting carried away in FOMO. And I would say the last but not the least, by saying no, life does not end. मैं मेरी टीम को बोलता हूँ, नहीं लेके रोना, लेके रोने से बेटर है कि नहीं? नहीं लेके रोगे मानी आपका कैपिटल प्रोटेक्टेड है, लेके रोगे मानी कैपिटल में डेंट है. So I think this is a time when you have to enjoy what you have made. घूमने जाओ, महीना 2 महीना घूम के आओ. हम फ्लाइट की टिकट में इतना कंजूस हूँ, अभी भी देख रहा था, जाते वक्त मैंने इंडिगो की फ़्लाइट नहीं की, आकासाकी की, क्योंकि 2,000 रुपये सस्ती है. और यहाँ करोड़ों लुट जाते हैं. मंडे को बाजार खुलेगा, इजराइल हैज बॉम्ब्ड ईरान, अभी कितना नीचे खुलेगा मालूम नहीं. उधर करोड़ों लुट जाते हैं, यहाँ 2,000 रुपये बचा रहे हैं. So I think enjoy what you have made. There is no harm in relaxing for 2-3 months. Let the market stabilize. Nothing will happen. You know, I'm not saying that the markets are going to collapse. But कुछ नहीं भी करोगे ना 2-3 महीना तो कोई नुकसान नहीं होने वाला है. बॉस अभी अच्छा टाइम है, ठंडी का मौसम है, दिवाली है, क्रिसमस है. Enjoy your life and learn to say no. Sorry, just being a little, थोड़ा जगाना जरूरी था नहीं तो भी.
It's trying to sober us all down. No, I think this has been a great conversation. I think one last aspect of what's happening around us now, and I think we're all coming in here from this last week, the week that it was, and there's been this whole trend of foreign investors selling. And we all realize that 10, 15 years back when foreign investors would sell, it would have a very disproportionate amount in the markets. Today it doesn't, and that's, I think, the good news. But then that combined with what we just discussed about SIP is going down from 25,000 to, let's say, 15,000. That's a very relevant number to not come into the market in terms of fresh flows. So if both of these combine as a trend, and the layer on top of that, I think, which is a longer term thing, is that this 12, 15 crore accounts are going to become twice or thrice as much. So two aspects on this quickly. One is the longer term thing, which I think is more veering towards domestic capital becoming more and more relevant and important for our capital market stability. But foreign capital is essential, not only to the listed companies, but also to the unlisted markets where funds like ours operate a lot. Yeah. I mean, just to share some numbers, over the last 10 years in the unlisted space, especially the early stage startups, etc., more than 85-90% of capital was foreign. That has gone down to really 10% of what it was, and therefore the outsized impact that it has had. So how do you see this shorter term and the longer term trend play out in the public markets?
So see, flows are definitely important, but flows are not the only thing. If you go back in history, and for those who have been in this market for a long time, maximum foreign flows came into India between January 2020 and March 2020. But it was the most disastrous time for equity markets even during that time and after that. So I think the only point I'm trying to make is that flows are important, but flows are not the only thing. But at the same time, I think hats off to all the Indian investors for having confidence in their economy finally after a long time. नहीं तो 5 साल पहले बहुत दुख होता था कि Indian economy is growing so much, markets are doing so well, but all the foreigners are benefiting and Indians are still trying to find faults. So finally that is there. On the foreign flows, at least my view is quite optimistic. Yes, you have seen $10 billion go out, multiple factors. Maybe Indian valuations were stretched. Then you had the alternatives of China coming in and so on and so forth. And in fact, last 3-4 months has not been great in terms of news flow. We had an election outcome which was not that great. We had budget which was not great because you have, taxation increased on equity. I think it got just absorbed. I was surprised. Then you had this multiple conflicts going on. You have had lot of issues in terms of it. Still, I think domestics have ensured that there is not too much of volatility, which is good because it adds to your confidence. From a foreign investor's perspective, 10 billion is what was not even peanuts ka peanuts. Total investable corpus is $70 trillion in the world. India has $800-900 billion. It's what, 1% of their flows. Now, to say that they will withdraw everything from India and invest where? I don't think there is any country which is offering the kind of stability, which we call it the 4D effect: democracy, demographics, domestic demand, and digital economy. Maybe the only democracy which has the same government, same prime minister, same policies for 15 years, one of the youngest populations. You have a great domestic economy. Was when the world was struggling to grow at 0%, we were celebrating weddings and anniversaries and birthdays like never before. Abhi bhi jao, flights are full hai. That's the power of domestic economy. And the digital economy is doing wonders. What we lagged, that the smartphones and this UPI and all, they are coming in. So I think foreigners will come. We have no doubt about it. China has obviously had some stimulus. So the near term, I would say the speculative money had some readjustment. But the kind of inquiries which we are seeing from global investors who want to invest in India through us is at a peak.
Fantastic.
Last, I think, Wednesday or Tuesday, we had 3 visitors in one day, which we have never seen. So I think this is a period where they will visit between October to February. Normally they visit. And allocation should definitely start. At the same time, just one disclaimer, I think this quarter results have not been great. We do expect that the second half will be very, very good because everything has got deferred. Monsoons were slightly elongated. Because the budget came late, the government spending got delayed. You had elections, so that code of conduct, the spending got delayed. Yeah. I think now we should start to see that. But that is very important because no amount of flows can sustain the market if the inherent fundamentals are not good. And I think what we have to see is first whether the next 2 quarter earnings actually bounce back. Because if that happens, then flows will also be good and the markets will also be good. If that doesn't happen, even with flows being good, the markets might not react positively.
Yeah. Thank you, Sunil. I think on that positive note of bye-bye.